Welcome to Tax Break, a podcast on the tax law brought to you by the lawyers at Miller and Chevalier. I'm Steve Dixon, a tax litigator with Miller and Chevalier. As usual, I'm joined by my colleague, international tax and tax policy expert Loren Pons. And we have a new guest today, our friend Simon Weber. Simon is a managing director at Duff Phelps, a firm that we have used for valuation services in many cases over the years. Simon provides global transfer pricing advice to Fortune 500 companies and startup businesses, especially in Silicon Valley, where he's sitting today. Among other things, Simon advises clients on cost sharing agreements, intangibles transfers, transfer pricing planning and documentation, controversy, and advanced pricing agreements. Welcome to the podcast, Simon.
Thanks very much, Steve, for the intro. I didn't know I'd done so much. That's great.
You're extremely accomplished. We only have the best on our podcast. So today we invited Simon on to talk about transfer pricing valuation as viewed through the lens of OECD initiatives, both sort of BEPS 1.0 and the shift to focus on DEMPE functions, and with the eye towards anticipating what might happen with Pillar 1 and Pillar 2 under sort of BEPS 2.0. As we always like to say, the idea behind Tax Break is to provide listeners with some perspective on select tax issues that we think are interesting. We want to go deeper than what's in the tax press, but stay sufficiently high level so our listeners can follow along without a copy of the regs, or in this case, the latest OECD reports in front of you. And as always, a disclaimer: Tax Break is not intended to be legal advice, and you cannot rely on it as legal advice. Its content reflects only the thoughts and opinions of its hosts or guests. So, Simon, if you could, I'd like to start out by you telling us a little bit about how BEPS 1.0 affected and continues to affect today your practice in valuing intangibles for purposes of transfer pricing.
Yeah, that's a good question, and it's obviously impacted what we do a lot. The purpose of BEPS 1.0 was really to try and bring a lot of untaxed intangible value onshore to be taxed, as you know. But it also sort of changed how much you need to pay for intangibles when you move them, and then who should earn those intangible profits as they go forward. And so what we saw over the last few years is a lot of onshoring of otherwise sort of offshore intangibles and valuations around that, but also work around making sure that new owners or existing owners of intangible rights and profits sort of had sufficient DEMPE functions. And I think that when we look at that part of it, I think that's another area that's still ongoing. We really don't know the views of many governments and countries around what constitutes the DEMPE rules with regards to sort of profit attribution, and really how much DEMPE do you need, right, to be able to sustain your sort of legal positions. And I think that we do see differences around the world and positions around the world in that respect. I mean, I think the US, it would be fair to say, still values legal rights and will sort of ground on the legal ownership of intangibles, as long as there's sufficient DEMPE functions. And I think the regulations that were already there sort of had an economic substance and test that you could apply around that. In foreign jurisdictions, you find that that view may be different, and even between advisors, you find that differs. And there's now sort of a move that may suggest that having dispersed DEMPE functions may actually mean a dispersion of intangible profits. So I've seen things where there's been sort of profit splits applied, where there's been sort of fragmented DEMPE functions, and so sort of you get into this debate about how much is enough and what activities are more valuable than others, and it gets a little bit more messy, and that then sort of moves into, when you're moving IP, well, who should pay for what and how much should they pay? And so you get this sort of wide variety of different outcomes that may be applicable. We do a lot of probably 80% of my work is intangible valuation, and I see a lot of different rules being applied or thoughts being applied around it, and you sort of have to be adaptable in how you approach it.
And could you, that's interesting, the notion that having dispersed DEMPE functions leads to a division of or a greater allocation across jurisdictions for income to intangibles. Is that the idea?
I think that's the idea. I'm not a subscriber to that view. I think I'm more on the US side, where if you've got sufficient functions, you do it. But I've seen analysis that look at activities and DEMPE functions, and basically, I think if you've done any supply chain stuff, there's I think got a RACI analysis, and I forget what those acronyms are, but basically it looks at decision making around the intangible, development, enhancement, maintenance, protection, and exploitation. And attributes value across the people that are making those decisions, or the systems and processes that are put in place around it. And so, if you take that view, you could end up with IP value being dispersed in a number of different cases. The OECD provides very little guidance around it. Really, it just says that if you don't have DEMPE functions, then you get nothing. But a risk. Yeah.
But it doesn't tell you if you have some, how much you get. Yeah.
Exactly. And so I think, planners take different views on it, and I think companies may take different views on it. Some companies are going to have dispersed arrangements, right? There's going to be sort of, central decisions and local decisions, and that may actually naturally mean that there's some sort of dispersion of IP profits within the organization. Right. So it really depends on your facts and circumstances, which is the classic get out. Right?
So for the record, RACI stands for responsible, accountable, consulted, and informed. So the varying levels of I guess, independence that one might have with respect to these intangibles and decisions about where they're placed.
So do you have to have all four?
Well, no, it's kind of a descending order of,
okay.
If you're informed, you're at the bottom of the totem pole because the decision has already been made.
So it's sort of a hierarchy in deciding whether your DEMPE functions are sufficient.
Well, whether they're sufficient in terms, whether you have them, but then I guess to Simon's point, when they're dispersed, kind of assigning a degree of significance across the value chain when you're trying to determine.
You can end up with a notional profit split that way, right? It's not really a financial profit split, it's more of an activity-based profit split.
Right.
Obviously determinant on somebody's opinion about how much value a particular activity, decision, or piece of information is worth. And so I find those analyses interesting, because I think they give you some insights into how things work. I find it less convincing from a valuation perspective, and I think you're always better to look at other aspects as well as the legal part of it, the equation as well. So I tend to use these things as sort of an indicia of strength of positions rather than an absolute.
Right. So it's kind of a back of the envelope analysis of whether you're going in the right direction.
Yeah, exactly. Whether it makes sense. Mm-hmm. So I think that's a good way to use them. But I've seen them used more proactively as the sort of the primary method as well, which is I find interesting. So
it's creative.
There's a variety of things out there.
Yeah. So Pillar 1 has been out, I guess, for like a year now, right, Loren?
Well,
like in terms of at least the report, the blueprint.
Some meat on its bones only recently, so there's been a lot of talk about it, but the actual reports with great detail came out in October this year. So there were leaked sets that came out in August, and then the official came out in October. But before then, it was really more of a concept, an idea about generating what some might view as excess profits in certain markets without having a physical presence necessarily. And what started as an idea about digital companies and the way that they operate in certain markets has really kind of morphed and expanded to encompass more than just digital companies. writ large.
It was number one. So it was number one on the BEPS list of
exactly
things to do, right, in 2014.
Yeah,
Can't believe all that.
It's
6 years on.
It is, yeah. It's a continuation of a concept, and it's really, of course, new ideas about profit allocation and nexus, jurisdictional nexus. But I also think of it kind of as an expansion of what an intangible is. And BEPS 1.0, we're thinking about intangibles and looking at DEMPE functions and where value is generated. And now we're saying that you're generating value just by virtue of the fact that you're able to penetrate a market without physically being present, and trying to essentially treat those excess returns or residual profits as something that needs to be allocated among the various jurisdictions in which you're operating. So it's an interesting.
Yeah, source-based taxation for markets, right? Basically,
right.
Overlaying the traditional transfer pricing, functions, risks, and assets within an organization. It's sort of super the organization and giving some weight to the markets. And you can see why countries would be interested in doing that.
Well, yeah. I was just going to say, it's kind of a re-articulation of an old idea. Years ago, people were treating the market as the intangible and demanding additional returns under traditional transfer pricing methodologies, just by virtue of the fact that companies were able to operate in their market, and given the size of the market and the buying power and the scope, that they should be attributing some additional or excess return to that market.
Yeah, I started my career in Japan doing defense work there, and so that was the big thing with the pharma and medical device companies. It's just this market's special, and you need to pay more because your pricing's higher and all the rest of it. And so it was interesting later on to see those same arguments, come round in the GlaxoSmithKline case, right, in the US, where the US were using those arguments.
Yeah.
And so, what goes around comes around. And
what's old is new, and
that's right. Disco music's coming back.
So what does that mean from a valuation standpoint? I mean, does that sort of change the fundamentals of the role of a valuation practice going forward, or?
Yeah, I think that is a really good question, and I'm not sure I have the answer for it, because essentially, Pillar 1 and Pillar 2 are meant to be overlays to the existing system. So in my view, I think the intent is for the existing system to view, the activities and contributions within an organization as driving that initial layer of taxation and transfer pricing. And I think that will also drive the valuations that will occur. But obviously, when you're trying to overlay taxation on top of that for the markets, now assuming that BEPS has been successful in driving, all profits onshore somewhere, so they're being taxed somewhere, then we're now going to get a situation of double taxation, and that's on an ongoing basis. On an annual basis, and then as you say, you then get these issues where if you are moving intangibles around and those intangible values are sort of following legal substance and DEMPE substance, which is inherent within the transfer pricing world, but inherently not in the Pillar 1 world, then I think you're going to start seeing sort of transactional double taxation issues that arise around that. And I think the Pillar 1 proposals deal with it to some extent. Some of it sort of, gets wrapped into things like purchase accounting and amortization of intangibles. But, also it's missed in things like non-amortization of goodwill, for example, which stays on the balance sheet unless it's impaired. And so, that's one of the areas that I think we'll probably be commenting on the Pillar 1, which is just really to sort of note the fact that you may have quite large transactions that capture value within transfer pricing rules and regimes that actually sort of bleed into the amounts that are also taxed in Pillar 1 and possibly Pillar 2. that would need an attribution or some form of recognition, and those values could be quite high depending on the definition of what was valued at the time, which sort of goes back to BEPS 1.0.
Right.
And the expansion of the definition of intangibles to include things like, potentially goodwill or other PPA concepts.
And it seems like the interaction between this sort of existing transfer pricing regimes that are in place and then this overlay of pillar 1 and possibly pillar 2, a lot of the devil in sort of reconciling those two layers is in the details. And in this, I know for pillar 1, right, there's this notion that we're going to have some dispute resolution mechanisms, but we kind of don't know what those will look like yet.
Right.
And so the devil's in the details. We've got to sort of figure out how those disputes will play out. And that's obviously something where valuation will be key in
sourcing. I think sourcing where tax was originally paid and how it was originally paid, and whether or not that needs to get reallocated or how it's taken into account. And I think the OECD sort of understand, I think, most of the issues of how this is going to work. And the trouble is that there's not enough specifics to see how much is really going to be in this overlap or margin. And so, it will depend. In pillar 1, you have this sort of carve out. It's a residual profits concept, right? And then it's only a portion of or a percentage of the residual that's going to get taxed as being sort of attributable to the market. And so if the distances between sort of, transfer pricing, routine returns, let's say, and, which would for transfer pricing would drive residuals. But if the distances there are reasonable and, most routine returns would be, captured within the carve out for similar ideas within pillar 1, then there probably is not too much of an overlap. And then if you've got sort of, not too heavy an attribution of remaining profit to the market, that will also put some distance between the regimes and make it a little bit smoother around double taxation. But that's obviously not the intent of trying to tax those profits, right? So we'll have to see how it all comes out. I mean, the sort of numbers you saw in pillar 1 where they were saying, we don't know what the carve out is for routines yet on pillar 1, but if you looked at the percentages that were being put out there for the percentage to the markets, it was somewhere between 10 to 30%, which that's not egregious depending on the contribution you think the market plays in a particular business or the market contributions play in a particular business. So there seems to be some separation around that.
Yeah, but it's supposed to be a modest portion of the residual. And I think in the examples of the pillar 1 blueprint, it's, they assume a profit margin of 10%. And anything in excess of that, 20% of the excess will be attributed to that market. And a lot of companies are of the view that that is a more than modest reallocation of profit. And so, it all depends on the percentages. But as you say, decisions made 2, 3, 4 years ago roll into these calculations today. So I see double taxation issues going forward, but also significant transition issues from an old regime to a new one, whereby, in the US 482 principles or traditional transfer pricing principles have not been abandoned for many other purposes. And how are we going to reconcile those? So
yeah, well, someone's paid tax somewhere on the profits that are going to be taxed newly, right?
Exactly.
That's the biggest concern. And there are, I think there's obviously going to be overlap because the same profits have been taxed. And I'm not sure the double counting adjustments or the safe harbor that are going to capture all of that. And then there's rather convoluted mechanism for identifying who would actually have paid the tax under the transfer pricing regime,
right?
With the paying entities and then a bunch of panels for tax authorities to figure that out. On whether or not you're going to get an exemption or a credit will affect timing. So I think, the devil is in the details, but I do see a situation where there'll be quite a large advanced payment of cash taxes in advance of maybe getting some of those credits. That would be my concern around it.
Well, credits, and then the credits have to be recognized where you would like to apply them, right? So we can't make somebody recognize foreign tax credits in a different jurisdiction. So you have to hope that they'll be creditable where you're trying to apply them.
And presumably that the sort of the effect of this will be the greatest where you have differences between the country where you own the IP and puts a lot of emphasis on ownership, and where there's actually like a lot of market value to the IP in markets outside.
Right.
Yeah, someone's going to have to give that taxing right up and be willing to do so. So I think it's interesting as well. There's, when you're thinking about where is it sourced from, intangibles have a long life in many respects, right? I mean, maybe market intangibles don't, right? It might be the instant wherever that person is that gets served the ad if you were in sort of Google's world. But sort of other technology intangibles may have lives that are much, much longer. And when you think about the way that Pillar 1's being structured, based on sort of consolidated group financials or perhaps segment financials, there's going to be a lot of subsidization between profitable and non-profitable markets. That's going to be an interesting, debate, I think, amongst tax authorities. I suppose the one good thing for companies is that they sort of know what they're going to pay, and it then becomes up to which countries are. Yeah.
Where becomes the question.
Well, they're going to pay. Where can they get it back, right?
Yeah.
And they'll be right, and they'll be to a certain extent indifferent, so long as it doesn't change their effective tax rate.
Yeah, and I think that would be appealing, but I think it comes down to the timing of when you get those credits. So I mean, anything that's an exemption is obviously going to be a lot better than a credit system. Yeah. So but how you administer all of that, I don't know. Especially since it seemed to be that everything was going to be by panel on the tax authority side. So when you're looking at the number of companies that were captured, right? I think what was it, 8,000 companies over 750 million euro in revenues, and then if you applied the what they thought were the
thresholds,
the thresholds, it was like 2,500 or something like that.
It's a lot of work for panels.
Yeah, I was gonna say. Yeah.
Hard enough to get a few people to agree on one.
Right. Exactly. But no, that's an interesting point. I think, there's a presupposition that you're profitable in all of these markets, but it's not always the case. And there has been kind of a push to take into account not only losses and carry those forward, but also profit shortfalls. So, we're not 100% in loss territory, but we're not making as much money as we think or we thought we would, or that we might in the future, particularly if you're looking at markets where you're just kind of starting up. So, you're operating at kind of a break-even point, and you will be, but that's part of the cost of getting established there.
It really depends on the business, how it goes. I mean, you could sort of contrast something where you have a sort of a platform that works, that's sort of developed and works, say Google's sort of ad serve platforms or things like that. The point being that incremental users and markets are literally marginal cost to them to put on. But then you've got other companies that may have to invest significantly in developing the market, the Netflix of the world and things like that, where they're trying to build market revenues, $10 a month per user at a time, right? And having to spend millions of dollars on content to make that happen. So I think the OECD seems to have done a good job of recognizing that, but there's temporal distortions that are going to come through, right? And it's a balance between getting the simplicity they want to administer this, and the complexity that would bring more equity. And I think that's not something I think that's easy for taxpayers to actually sort of opine on. Really, that's something that's a policy decision between governments to a large extent. So and you see that throughout, right? I mean, you do see that throughout the Pillar 1 proposals and even the Pillar 2 proposals, that balancing act they're trying to do. And it'd be interesting to see where they go down deep and want the complexity, and where they want the simplicity. My sense is that the complexity probably needs to be at the sort of the credit end of it. Who's going to give up, rather than at the how much you have to pay end. But I think with some of the proposals like segmentation of financials, that there could be ways for companies to at least alleviate some of those issues around sort of significant subsidization issues. But it might mean changing what they actually disclose in their financial statements, and thinking about that now, right? If you think that this probably won't go into effect for 3-4 years, maybe now's the time to start thinking about whether or not you might want to have more segmentation in your financial
if it can help you. Yeah, no, I think that's right. You want a blunt instrument in terms of kind of the rules themselves, and where you do want the complexity is to avoid the double taxation. So that, and it will be complex. I don't think that there's any way to have a simplified dispute resolution mechanism with these rules.
No, I agree.
If they're kind of very generalized and meant to apply broadly, and get to a rough estimate of what these profits are and where they need to be.
Could you elaborate on that, Simon? Could you elaborate on the notion that sort of segmentation of your financial results is something that would drive your ability to sort of decide how much income effectively, to have some leverage in deciding where your income gets allocated?
Yeah, so maybe you could give an example, right? So, I'll pick on a company like Netflix, because they actually disclose their foreign markets. And what you see over the years is that the US market, was initially driven by sort of, the mail in the DVD business. And then it became an online business, and that took a while to become profitable, but now it's super profitable, and we're all enjoying the benefits of that. But in the foreign markets, what you've seen is significant losses over the years, and that's because it does take them a long time to actually develop those markets for them to become profitable, right? They have to buy the rights to the content, and actually create the content these days. For each of the markets that they serve. And yes, there's content that's used across markets, but those are quite significant costs compared to the revenue build that they have. And it might take them, if you look at the financials that they have, it looks like there's probably 5 or 6 years before the foreign market segment, looks like it could get profitable. And I forget, I haven't looked at it for a while, but it may still not be profitable given their sort of market expansion. And so, when you're looking at that may be, if you're looking to sort of segment out sort of foreign market, contributions, that might be an appropriate segmentation to look at. It's not at the same level as the Pillar 1 proposals. They start at profit after tax. So there's a number of things that most companies segment down to operating profit at most. But companies could look at that, and whether or not disclosing more financial information about market segments that they operate in, and also geographies, might help to move or allow them to use those as a basis for Pillar 1 taxation, as opposed to sort of the global worldwide income statement. And the OECD set out some conditions for whether or not they would require segmentation, right? As well as, but there may be sort of opportunities for companies to steer that discussion as well, if it can be shown that it's reliable.
And then companies have to weigh the sort of the possible tax benefits of that segmentation against any sort of competitive concerns about providing more granular detail about their business in different countries.
Yeah, absolutely. Yeah, and whether or not that would be acceptable, right, by the panel that's associated.
These panels, the specter of the panels.
Well, this has been a great panel, and we've really enjoyed having you on, Simon. Loren, is there anything else we should?
Well, we didn't. Simon mentioned timing, and this would give me a little bit of an opportunity to do my favorite thing that we do on the podcast, which is prognosticate. So, what do we think about the timing, and how do I think personally this is going to be a much longer runway than this aspirational July 2021 deadline that has been established. but realistically, what do we think in terms of implementation, and what should taxpayers be trying to think about in terms of when these rules are going to come online? Are they going to be staggered such that we worry about pillar 1 before pillar 2, and things like that?
Oh, you want me to give no, I have
Simon,
no idea.
You got to prognosticate. Come on.
I was hoping you'd do it.
So.
We'll watch
hang
on. I'm going to open the betting markets and we'll watch them move as you give your prediction.
I put good odds on DSTs coming first, quite frankly.
Enforcing the issue.
Yeah.
And I just think, it's very difficult, right? If you think this process didn't start in 2014, right? Because basically it was tabled at that time.
Right.
Pretty
It was.
quickly,
It was.
right?
It was hard.
Really
it was hard to deal with, and so.
Yeah, it was too hard to deal with. But the one, it was the elephant in the room, and so I think as a new tax system, which this is, right? And I know Pillar 2 is a little bit more like guilty, but let's say Pillar 1 being a brand new tax system with a new international framework has come a long way. But I think there's just a long way still to go to really make it work well. And I think that's an important consideration for the OECD. So in terms of timing, I think I would prefer to see them, if they're going to go quickly on it, to assuage DST advocates, then I would prefer to see them make sure that the elements of friction, the overlaps on the margins, are as small as possible, and to have it be successful. And so maybe that means limiting and, as you say, sort of staggering how the companies that deal with this, and sort of bring it in over time in a phased manner so the issues can be resolved. I think the worst thing that the OECD could do would rush into this and it become really quite a big mess for everybody to deal with, without the resources, double taxation. You could see this really sort of undermining, what might be the embryo of a different form of taxation.
Right.
Maybe it is the embryo of formulary apportionment that might work, that may reduce all of the compliance costs that we've got. Right?
It could.
Lauren visibly winced.
I know.
I did. I thought we were going to get through the podcast without mentioning
calling it that, right? Well, it isn't right now, right? But the mechanisms are very similar.
They are.
And so, if you really sort of think about the tax system, so is anybody really happy with the tax system? If this was a business that wasn't taxed, it would be ripe for disruption. and I'm not sure that what we're doing right now, adding 2 more or 3 more layers of tax, is actually going to help matters. It might actually push us more closer to the implementation of some sort of more grand simplification. But this is basically the OECD's grand experiment with these types of ideas. So we'll have to see how it goes. I'm not going to say I advocate for it, but I would say that if I was prognosticating, I would say 5 years to get it fully implemented and bedded in is probably realistic. And I would hope that they, as I said, they do it in a staged manner and sort of feed it in, and they can change thresholds at that point. But for the world, I think it's important that this is successful, because I think it's going to be hugely expensive. It's not for everybody.
It is going to be expensive. I agree. I think a much longer runway than what people are actually contemplating is preferable. And they can make tweaks along the way if this happens in stages, instead of just unleashing, a new system across
the world.
100 and something tax authorities of varying degrees of staffing and sophistication and all the other.
Well, I'm sure the markets that benefit from this will be glad to further put off their COVID debt relief programs until this is in place.
There are always digital taxes.
Well, that's what fills the gap, right? That's what enters the void of
print more money.
Print more money.
That works.
That's right. That's right. Great. Well, Simon, it's been a pleasure having you on the podcast. For our listeners, You can always email us if you have any questions or want to suggest future topics. The email address is podcasts@milchev.com. That's podcasts plural at milchev.com. Thanks for coming on, Simon.
Yeah, thank you very much.
Thank you.
Great to see you.